Okay, so in this chapter, we're going to be talking about statement of cash flows. And we talked about the statement of cash flows really early in the semester, like week 1, week 2. And I told you guys, I'll be honest, it's probably my least favorite financial statement to cover. I think that it gets unduly complicated for what this class needs to know. So, in the interest of that, we're simply going to talk about the classification of activities on the statement of cash flows. This is kind of knowing what goes where, right? Why do we do the statement of cash flows? How can we use the statement of cash flows to make some decisions? We're not going to talk about the preparation of the statement of cash flows at all, really. Okay. So in part A, talking about the classification of cash flow activities, we're just going to remember why. Why do we produce this statement? Well, it's because it's a complementary statement. It complements the other two statements. If we think about it, the income statement really doesn't tell us that much about cash at all. Cash isn't an account on the income statement, right? It's an asset, so it goes on the balance sheet. We do have revenues, we do have expenses, but not all of those are cash revenues or cash expenses. Some of those were promises to pay us cash or promises for us to pay cash. So when we're creating the statement of cash flows, it gives a more truer story of what's happened with cash. Okay, and as far as the balance sheet is concerned, really all it gives us is our ending balance of cash, or our balancing of cash as of the time that we wrote, or the time that we ran that balance sheet. So we don't really know how we got to that cash amount. Now, one thing to note, to create a statement of cash flows, to prepare a statement of cash flows, you need complementary balance sheets, okay? Okay, so you need a complementary balance sheet. This means last year's and this year's, okay? And you need this because last year's has this year's beginning balance, this year has this year's ending balance, right? And the difference is the change in cash. And we need to reconcile that change of cash to the change of cash in our cash flows. This is something that could be tested on conceptually. So just understand that, know that, okay? Now, we've been doing this all semester. We just may not have talked about it in detail every time we did it. But every transaction that we have talked about this semester, and we discussed this back in like week 1 and week 2, falls under one of these activities. It's either operating, which are going to be kind of receipts, payments, disbursements for transactions that associate or relate to revenues and expenses. So our operations, as it says here, the things that we're doing to operate our business, those are going to be the, spoiler alert, operating cash flows. Investing gets a little more, I don't want to say tricky, but these two right here get confused, investing and financing. What investing is, let's say you're a farmer, and you go out and you spend $200,000 on a new combine, right? That is an investing activity. You are investing in a long-term asset, okay, that's going to benefit you in future periods. You are investing back into your company. It also includes current investments. So any investments that we consider to be current because we expect to see that cash in the next year, right? So we're going to include these, okay? And then finally, we have financing activities. These are how are you getting your money, right? How are you getting money? Okay, so really, how are you getting money to operate? How are you getting money to invest? This is financing. Are you taking out notes, loans, bonds, that kind of thing? Are you selling shares of stock? Those are all financing activities. I would be able to classify for your exam, okay? Be able to classify different activities for the exam. So if they ask you, hey, you paid dividends this year, what kind of activity is that? And is it an inflow or outflow of cash? Be able to answer that kind of question. This is in your notes. This is a good example. Please note, though, that this one should be financing. Okay, this bottom one, I've got to get to McGraw-Hill and talk to them about that. This bottom one is financing. So this is just a list, and it's not an exhaustive list, but it is a fairly good list of inflows for each activity type, outflows for each activity type. That way, if you're trying to answer this for answer these conceptual questions on your exam, you could use this as a reference. Okay. Now, the one that people get confused about is dividends, because they can be classified differently depending on what you are doing with them. So if you were receiving dividends, this is dividend revenue, right? If you were getting dividend revenue, it's an operating activity. Revenue, just associate that with operating, okay? And if we are getting revenue, that goes to our operating section. If we are receiving dividend revenue, it goes to our operating section, okay? If you are paying dividends, that's a financing activity. We are servicing, it's not really that we're servicing a debt, but we are paying out that reward to our investors, right? We are giving them that cash reward for investing in our company, okay? So if you're receiving dividends, they're operating. If you're paying dividends, they are financing. This slide is just for you visual learners. This is a good one to know. There are lots of good conceptual questions here as well, but this will help you understand where each of these items goes on the statement of cash flows. So this is a good one to study and know as well, to be prepared for the exam, homework, quiz, all that good stuff. We're just reiterating here, and I'm going to give you some general guidelines and some general rules here. Okay, so your general guidelines to use when classifying, and I've told you guys this before in the class, when I say a general guideline in this class, it's safe to say you can just follow that guideline and get the answer correct. So when we're talking operating activities, generally they're going to be income statement items, okay? But any changes in current assets or current liabilities. And why is that? Well, because we expect the cash flow this year. Right? So that's why we consider current assets, current liabilities to be part of our operating activities. Investing activities, they're going to be changes in long-term assets. Remember, long-term assets are your PP&E, okay? So changes in PP&E, whether those are increases or decreases, those are going to be investing activities. And finally, financing activities involve changes in long-term liabilities, right? Long-term because we don't expect this cash flows this year. And stockholders' equity because we have sold ownership in our company, and that is how we got the money, right? We got the money through selling ownership in our company. So we're going to talk a little bit about cash flow analysis here. And I apologize. I'm making this video longer than normal, but it'll be the only video for this chapter. Okay, we're going through this chapter really quickly. There's not a whole lot I really want to cover with you. I would say understanding conceptually, classifying those different types of activities, and then doing your ratio analysis. Those are going to be the most important things to understand in terms of testing for this chapter. Okay. So one thing we can do with the analyzing cash flows is we can kind of tell where a company is in their life cycle, right? So if you've taken economics courses here at the university, you know that there's kind of a pattern that businesses follow during their life cycle, right? They've got the growth stage, or the startup stage, a growth stage, steady state, and a decline, right? All companies follow that. Eventually, almost all companies are going to be in a decline stage. All of them all start in a startup stage, okay? We can, with fairly good accuracy, determine what stage of life a company is in based on their cash flows from these different classifications, okay? And that may help us make a decision. Do we want to invest in a growth company, right? Or do we really want to invest in a declining company? Do we really want to lend a declining company money, right? So we're going to be able to tell at least rudimentary analysis of where is this company at in their life cycle, okay? That'll help us make decisions. That's going to lead to a deeper analysis, looking at their 10Ks, looking at their financial statements, examining the notes, the disclosures, see what's going on with them. But this is a good place to start, okay? I would know this for your homework, okay? I know for a fact you have a homework question that is this, essentially. Well, it'll really be like the example that we look at here in a second, but it is essentially this, okay? So when you're looking at a startup company, you're typically going to see your operating cash flows are going to be negative. Why is that? Well, you're not generating all that revenue yet, right? You're not generating a ton of revenue. Your investing cash flows are also probably going to be negative because We're investing in long-term assets. We're investing in that PP&E that are going to benefit our company over many, many different periods, right? We're purchasing that equipment that we use to produce our product. We are buying a building to operate out of. We are buying a piece of land to operate on. We are buying vehicles to deliver our products. All of those PP&E investments, all those big capital investments that we make, right? That's why we see a negative cash flow and investment for startup companies. Typically, you see your financing cash flows as positive, right? You're going to see a positive cash flow in financing simply because if you are a corporation, if you're a startup corporation, you may be selling stocks. That is a financing activity. That's an increase or an inflow of cash from a financing activity. If you are a sole proprietorship or maybe a partnership, you may be taking out loans from the bank, and that is an inflow of financing cash, okay? Then we got growth companies. These are companies, so startup companies start here, right? This is your startup phase. Then you have a growth company. This is when you're doing this. You're growing those revenues. So typically you're going to see a positive, negative, positive cash flow. So you're going to see positive operating because your revenues are coming in, okay? You're going to see negative investing cash flow because as that money's coming in, you're still pushing it out the door to invest in more PP&E, to invest in more equipment to help you generate more revenue, right? So you're going to see a negative investing, but you're also still financing some of these things too. So you're going to see that positive, negative, positive there. Okay. And then we've got the steady state. This is this portion of your lifespan right here, right? So this is where you're at here. Typically, you're going to see positive, negative, negative cash flows. You're going to see positive operating. You're still investing. You're almost always investing. It's okay to see negative investing cash flows, right? It's not a bad thing. And you're going to see negative financing. Why are you seeing negative financing? Well, because you finally got enough retained earnings, or you finally got enough free cash flow that you can pay back some of those debts. You can service some of those debts. You have enough free cash to do that. So instead of bringing in or having an inflow of financing, you have an outflow of financing, meaning you're servicing some of those debts, okay? And then finally, you have your decline stage, which is right here. This is what we're seeing here. And you typically have a negative, positive, positive cash flow. Negative for operating. Why? Well, because you're seeing less and less revenue, right? Positive from investing and positive from financing. Financing, maybe you are trying to get back to a growth stage, right? Or get back to a steady state stage. Maybe you're here in the life cycle and you just want to remain steady. So you're financing more and more to try and get back in that steady stage. Maybe you are selling off some of your assets you don't need anymore. Maybe some of that equipment that you used is outdated and you don't need it anymore. So you're selling it off, right? So just be familiar with those. This is a good one to kind of know for your homework, at the very least, probably for an exam as well. Your homework really is, the homework problem you have is going to look like this, but probably with just one company, right? It's only got one company. Okay? So you could look at these cash flows and kind of tell me, where are we at? Where are we at in the life cycle, right? So Anthem, they've got a positive, negative, negative. They're probably in a steady state, right? Lyft has got a negative, negative, positive. Okay? They're probably in a startup state. Right? So you can look at these, and maybe not with 100% accuracy, but with enough accuracy that you could go do some additional research and make some decisions from that research. Okay? So this is going to be very similar to your homework. You're going to have a question that says, hey, this company here has these kind of cash flows. What state is it in? Okay. So let's talk about cash flow ratios. This is the last part of the chapter for us. Okay. So these are complementary or supplementary analysis. Okay. The statement of cash flows is a complementary statement, so it would make sense that the analysis and the ratios that we use are also going to be complementary or supplementary. Okay. All we're doing though is we're taking some of the ratios we learned in chapter 7. We're just going to substitute cash flow from operations in place of the net income number. And you'll see that as we move along, okay? This I like as a question, as a true-false question. It could be true or false. Positive cash flows from operations are important to a company's long-run survival, right? So I would want to know that. It's a pretty obvious one. I would consider that to be kind of a give me points on an exam or a quiz. Okay. So these are the numbers that we'll be using for the examples for the ratios in this. However, we've already learned these in Chapter 7. Okay. We're re-examining some ratios that we learned in Chapter 7, and we're simply going to replace net income with operating cash flows. Okay. Alphabet, I believe, is just Google. So it's not just a made-up company, it's an actual company. Okay. So first, let's look at return on assets. This is one we learned in Chapter 7, so this is not a new ratio for us. It is your net income divided by your average assets, right? Your average total assets. Okay. So we take our net income from each of them, divide our by total average total assets. Remember, it's beginning plus ending over 2 equals your average. Okay. So your average total assets, you see here, we're getting a return on our investment in assets of 16.1 cents per dollar and 14.3 cents per dollar. So here, just looking at this one ratio, it would kind of look like Apple is maybe outperforming or more efficiently handling their investments on assets to help them generate some income. Okay. But if we flip that on its head and we kind of look at the cash aspect, we only want to see the cash. Because remember, that net income number includes things that are not cash, like receivables, right? So instead of net income, we'll replace that with operating cash flows. And we'll divide that by average total assets. Now we see that Alphabet's actually using their assets, leveraging their assets a little better to generate actual cash flow. Okay. So why would it be? Why would that be? What could a reason for that be? It could be higher prices. Could be they're selling more. It doesn't look like that's the case, right? But it could be one of those things. It could just simply be that, Alphabet doesn't extend credit to quite as many people, or they extend credit only to people that are more creditworthy than Apple does. Okay. Now, again, just like the return on assets formula from Chapter 7, we can break down the cash return on assets into different components. Those components are the cash flow to sales, which is a new one for us, and asset turnover, which we already know from Chapter 7. So once again, we can just simply eliminate net sales from the numerator and denominator of these two, and you get operating cash flows over average total assets. So this one right here is your cash flow to sales, and we will calculate that here pretty quickly. Okay. So the the cash return on assets, all we're doing there is we're measuring the operating cash flow generated per dollar of assets. Okay, so for every dollar of assets I have, how much cash flow am I getting for that? Okay. Cash flow to sales, it's the same thing, except we're looking at dollars of sales. For every dollar of sales that I make, how much am I generating in actual cash flow for myself? And then asset turnover, we already know from Chapter 7, right? It just measures the amount of revenue that you're getting for every dollar of assets that you're investing in. Okay. So the cash flow to sales ratio, this is the new one. It's the first new one that we have. We got one more new one to talk about, but it's even easier. So for cash flow to sales, we're simply going to take operating cash flows. We're going to divide it by net sales. That gives us cash flow to sales. Okay. So for every dollar in sales, you can see that Apple's getting 29.2 cents per dollar, and Alphabet's getting 35.1 cents per dollar. Now, these are both relatively high cash flow to sales numbers, but it would appear that based on sales, just sales alone, Apple's using their assets a little more efficiently. Remember, that was your return on assets, so your net income, not just your cash. Okay. The next new one we have is free cash flows. So free cash flows, essentially, what those are, they are simply how much cash do I have left to use for what I want after I have made expenditures on my capital items. So those capital assets, after I take the expenditures from those into consideration, how much free cash do I have? All we're going to do is take the operating cash flows, and we're going to reduce that by capital expenditures. Don't worry, this will always be provided for you. You're not going to have to calculate this in this class. It will just be, this is a number taken from your statement of cash flows, so you'll just be told your capital expenditures were this, your operating cash flows were this. What is your free cash flow? Okay. Typically what managers like to do with this is they will they'll service debt with these free cash flows. Okay, so they'll pay back some principal on some loan early or something like that, right? They'll start paying down bonds. They'll start servicing all kinds of different debt, right? It's a good way to help one of your other ratios, right? Your debt to equity ratio, or your, it's a good way to do that. So that's what free cash flows is used for. Okay. So you can also take your free cash flows to sales to get a ratio so that we can compare these two companies. Because if you look here, you've got like $41 million difference between free cash flows. It's hard to make that comparison there, right? So you just take your free cash flows that we calculated on the last slide and you divide that by your net sales. Now notice this is net. If that's going to be your sales less any discounts, less any returns, right? Less any allowances. That's going to be your net sales. Don't forget that, okay? So gross sales up here, less discounts, returns, allowances, that's your net sales. Don't forget that this is the denominator here is net sales, okay? So here we can see they've got 24.1% cash flow to sales and 16.7% cash flow to sales. So basically, for every dollar of sales they make, they've got free cash flow of 24.1 cents, 16.7 cents, okay? Now, while this may look like the better number, that's 24.1%, what we can look at and say is, well, maybe, just maybe, Apple's not investing in capital assets the way that they should. We want them to be investing in capital assets because those help us generate more cash flows in the future, right? So that's one way to look at it. Maybe Alphabet's investing appropriately in those capital assets. It also means they've got cash just sitting around. For every dollar in sales they make, they've got 24 cents in cash just sitting around, not making any money. And anybody in finance is going to tell you, you want to have your money working for you. You want to be building wealth on your money. You want your money making money, okay? So you don't want it just sitting around. This is just a slide to show you in billions, right? And this draws your attention. This is why data visualization is so good. Free cash flows in billions of dollars. Apple's got, what, 64 million or billion dollars just sitting around in free cash. You may ask yourself, why is it so different? Why is there such a huge variance between all of these companies? Okay. Now, some of it is scale, right? Apple's way larger than a lot of these companies. But if you look at that ratio, that leads to more questions, okay? So finally, just a reminder here, your cash return on assets indicates the amount of operating cash flows generated for each dollar invested in assets. Know these definitions conceptually. You will be asked about them, I would imagine, on your exam. It will help you with your homework. It will help you with your quiz, okay? So just kind of know these items right here. Know that we can separate the cash return on assets into its two components, cash flow to sales and the asset turnover ratio. And that free cash flows just simply measures how much free cash do we have. How much cash can we use in a discretionary manner, meaning how we want to, however we want, right? So how much discretionary cash do we have? Okay. How much cash can we use on discretionary spending? Right. So, as always, if you have any questions, comments, concerns, anything like that, please let me know. I am always happy to talk to you guys.